find them. Now we have our guest joining us. Of course, Gautam Duggad is head of research at Motilal Oswal, and of course he is going to take some questions. Gautam, hi, thanks a lot for joining us. Has the market now corrected enough to be in value zone once again at index level, or do you think it's perhaps still some time away given the current sentiment?
Hi Anuj, good afternoon. Thanks for having me. Yes, it has had a decent amount of correction. We've gone through 2020, a large part of 2020 and entire part of 2021 without any sort of a correction or a material drawdown. Even now from 18,400, which was I think the top few months back, to about 15,800. In percentage terms, at least as far as index is concerned, the mainstream index, it doesn't look a huge correction, but the real damage has happened in the broader market. If you look at NSE 500, at least as far as yesterday's closing was concerned, more than 80% of the stocks were anyways down more than 20%. And some, obviously, we know 16% of the stocks down more than 50%. So clearly, value is far better today than what it was 3-4 months back. And if you go back to January when we had this conversation, our view then was it is going to be very difficult to make money in 2022. Of course, we didn't foresee this kind of a carnage in some of the small and mid caps. As you mentioned right at the beginning of your show, small cap is down somewhere, I think 30%. And on a trailing 12-month basis also, now it is showing a decline. So clearly, value definitely is there now in some pockets. But it is very difficult to foretell where this is going to stop, because we are living in a very different kind of a world now as far as macro is concerned. We have not seen monetary tightening for last 7-8 years. Of course, rate hike has been debated for a long time now, and we have seen one round of rate hike already. Several more you will see given where inflation numbers are. What is difficult to fathom is how the markets will behave once the actual monetary tightening and liquidity tightening starts. But obviously you cannot time it on the bottom, neither can we time the top. So wherever there is value, I'm sure it makes sense. If you have a longer term view, maybe 18 months, 3-year view, it makes sense to start nibbling there. Beyond that, it is very difficult to forecast where things will settle.
Okay. Gautam, hi, welcome to the show. Are you recommending to your clients that they deploy money at these levels now? Probably increase SIPs? What's the recommendation? Because I'm sure you're flooded with queries.
Yeah, so our clients are all institutions, so they don't do SIP actually.
I mean, even from the retail perspective as a group.
Yeah, so see, our bias is still towards large cap. I still find mid caps a bit more expensive, though there is some correction which has happened in mid cap, but relatively, I still continue to prefer large caps. So if you go by the earnings have been, a good story so far. Throughout FY22, we have not seen any downgrades. We started the year a year back with an EPS of 735 rupees, and now that earnings are about to end, it is going to end at 735. So throughout the year, a lot of things have happened. COVID, second, third wave, Russia, Ukraine, crude, commodity, Fed, tightening. I mean, all sorts of headwinds have come through. But the damage to the earnings have been very limited. Of course, there has been a churn within the earnings. So corporate earnings have been the star of FY22. We have seen a 35% growth almost, which is the highest since FY04. And even as we speak, while the narrative is turning more and more challenging, we've not seen damage on forward estimates as yet. Remains to be seen how things pan out over the next 6-9 months, where there is a problem on demand destruction or margins pressure. But we've not seen any material damage to even FY23 projections so far. We are still at about 870 rupees of EPS and 1000 rupees of EPS for FY24, which basically means that right now we are trading somewhere about 18 times 1 year forward and around roughly somewhere about 15.8 times FY24. What we are recommending to our clients is, wherever there is a very strong balance sheets and cash flow, which is basically sectors like IT, some of the commodity consumers now, the FMCG, discretionary consumption, I think it makes sense to start buying some of those names. Especially IT large cap has given a big correction, and there the balance sheet cash flows and even the demand visibility remains extremely strong. Banking has been debated ad nauseum. Now it remains a preferred sector, though the stocks have not done well. numbers have been pretty decent as far as private banks are concerned. We've seen about 44-45% profit growth versus expectation of 35%. Provisioning costs have undershot big time. What remains to be seen there is if PPOP can accelerate from where we are right now, that will be a function of credit growth. So selectively, depending on sector, depending on stocks, we are trying to see where we can.
In that, Gautam, were you surprised by the market's reaction to even the good bank earnings, whether it was an ICICI Bank or even a State Bank of India? Because one was getting a feeling that perhaps the market's making some distinction and the market's willing to at least, reward the good banks. But this week has been quite treacherous.
I think, when you see almost $1 billion of FI selling on a daily basis, there is no discrimination there. What gets sold, and what is liquid, wherever there is a free float, they will obviously be the ones which will get sold first, right? And this has been happening for the last 6 months now. We have seen almost $21-22 billion of FI selling since October. So yes, I was surprised because the last 2 quarters, if you look at the numbers of private sector banks, they've been very strong numbers, specifically ICICI Bank. But the point is, the sector, everyone has a consensus positive view. Everyone has ICICI Bank or some of the other banks in their portfolio as top ideas. So therefore, the problem is sometimes of over ownership and liquidity, and you cannot fight liquidity. Fundamentals are strong. There is no debate about that. We have seen banking earnings from FY18 to FY22, and they've gone up by 4x. The banking profits in Nifty in FY18 were 44,000 crores, and we're going to end FY22 at a profit of 1.5 trillion. So there is no debate on fundamentals there. Of course, there are non-fundamental factors, heavy selling that we have seen, and now, of course, rate hike and therefore potential damage to demand and consequent impact on credit. A lot of factors come into play when you talk about banks because it's one, end of the day, it's also a macro trade. So, but at the same time, valuations have not been quite attractive for the large cap private sector banks and also SBI in my opinion.
Okay, all right. And it was a great day actually on Friday for a lot of the broader market financial stocks as well, say for example, the Ujjivans of the world. But nonetheless, Gautam, what is your opinion on Tata Motors? Because that's a strong rally post its numbers. It was largely a mixed bag. India was good, JLR was a bit disappointing. But what's your view on Tata Motors?
On sector, we've been underweight for a very long time now. In fact, we have further increased our underweight, given that the pressure on supply, there is pressure on demand, and there is also an impact of input cost inflation, which is very clearly evident in the auto margins. But if you just go by the numbers of auto companies, this is the first time I'm seeing where auto companies have beaten our expectations after 13-14 quarters. Second, we have seen some earnings upgrade come through for auto, not for Tata Motors specifically. In Tata Motors case, we had to cut our numbers. Given multiplicity of factors at play, and it's always a bit of complex animal because of various business divisions and various geographies which are involved. Particularly to Tata Motors, while we like the name from a global exposure point of view, I think the journey as far as numbers are concerned on both profits and volumes is going to be extremely wobbly, given the exposure that they have to multiple geographies, and then therefore the pressure on the supply, the pressure of semiconductor supply is still not sorted. Domestically, there were a lot of silver linings. The CV demand, the PV demand, the numbers are pretty good. It's beaten our expectations on the domestic front. But all in all, we have still seen a double-digit earnings cut on Tata Motors.
Gautam, the big talking point this week was the big collapse in GNFC. Did you sort of understand what was happening here, or in the space, the kind of correction that we have seen across the stocks? Any thoughts there?
Which sector, sorry?
GNFC, the fertilizer chemical stocks, you've seen.
So we don't have coverage there.
Oh, no, okay. But what about the specialty chemical space? There also we started to see quite a bit of correction.
Yeah, but that's quite expected. Anuj, in specialty chemicals, the stocks were flying. There have been 3 rounds of earnings cut now in specialty chemicals since last 6 months. Second, the pressure on margins is quite well evident. You've seen 800 to 900 basis point of gross margin correction post-October. And valuations were super expensive for what was essentially a few quarters of a very strong performance. So somewhere down the line, the fundamentals and the market cap / performance had to converge. and we are still not there yet. I think the valuations are still very expensive in specialty chemicals, while the broader macro story for specialty chemicals, China plus one, demand, capex, all of that remains very attractive. The prices are still not very attractive in my view. So therefore, I would think that the risk reward still needs to tilt in favor of reward before one gets more constructive in that space.
Okay, all right, Gautam, we're going to leave it on that note. Thanks very much for joining in and speaking to us. So that's the view coming in from Motilal Oswal. We need to take a short break, but on the